Welcome to a new contribution of our FSC vlog with your host, Ron William, FSC Development Director. And this month we'll have a variation and a new focus on FSC peer insights, experienced cyclic influencers in the trading world, analysts, strategists, or authors with insightful work. And the spotlight is a recent FSC interview with Valérie Gastaldy, a market strategist and trader with a methodology rooted in cycles, sentiment, and technical analysis. The key market view is an initial market topping in 2025 to 2026 and a new volatility signature that will likely continue. She blends long-term cyclic models, sentiment indicators, and price action to anticipate key market points. A veteran of multiple market crises, she also teaches at the technical analysis at Schema Business School and is known for deep expertise in European equities and macroeconomic cycle forecasting. Now, Valérie is an industry peer and friend, also a active industry member of the International Federation of Technical Analysis. So it was a real delight to invite her onto the show, capture her insights, and to really look at cycles and how she applies cycles in practical terms as a strategist and trader. And this is one of the key reasons that I wanted to dive deeper into a post-interview spotlight. Now let's start with the approach itself. Just to recall for those of you who have already watched the interview and for those that haven't yet, a review: 3 stages: forecasting, assessing, and ultimately taking the action step in the end with a decision on trading and risk management. That's broken down into, on forecasting side, macroeconomic focus, more big picture, then sentiment, and ultimately price analysis. Now, on the macroeconomic side, this is where the cycles come in, and we'll dive deeper into the signature work of a cycle pioneer that she builds this work on. In terms of US markets, we're looking at economic indicators, including macro markets, which have a cyclic rhythm that can be measured. That's the first point to mention. So in terms of economic indicators, inflation, industrial production, and in terms of macro markets, yields in terms of bond markets, and equities, case in point, Dow Jones Industrials. Now, of course, this can be applied across other markets and other macro indicators, but this is US-centric here and now. On the sentiment side, it's the options market, looking at put-call ratios, something that I've used for years and many of you may already find value in. And in terms of a money flow and trend rotation, sector ratios is quite useful as part of a top-down approach. And then lastly, on the price side, there's a range of different techniques that we can all use, but the ones that she highlighted were key trigger levels in terms of the meaningful and sustainable moves that take place that produce attractive risk-reward opportunities. And as part of that approach, a proprietary indicator called Tom DeMark indicators. Some of you may recall that we did actually host Tom DeMark on the FSC Cycle TV some time ago. He's well known in the industry as a market timer, published many books, and has his own suite of indicators. You can look up more either with the FSC or elsewhere online. But that's just a roundup of the approach of the market practitioner that we are spotlighting today. Now, the cyclic work is based on a cycle pioneer known as Tony Plummer. Tony Plummer is a well-respected financial analyst known for his work on market psychology, cycles, and the role of order and rhythm in economics. He's particularly renowned for synthesizing ideas from financial market theory, behavioral finance, and ancient wisdom, including cyclic and esoteric models of time. On a personal note, I do want to highlight the point, because I've read Mr. Plummer's work for many years, but influenced it by it as alongside many others. And so it's important to also spotlight that his work has influenced generations of investment professionals. He's taught at the London School of Economics on behalf of IFTA, the UK Society, and his landmark book, which is one that is available for all of you to read more in as a complement to this session that we're having today, is Forecasting Financial Markets, and that's a useful reference guide post-session. Now, the quote here I included is, the process by which future unfolds is not a mechanical process, but an organic one. So he has this naturalist, dynamic philosophy and practical experience of not just markets, but life itself. And in another book that he published called Law of Vibration, he talks about the principle that reflects rhythmic movement of all things in the universe, including human psychology and financial markets. I love the connection between markets and mind, and of course, life itself. Now, the cyclic pattern, which many of you will be interested in, a schematic for financial markets that he developed a long time ago, is based on this signature concept of a cycle triad. Now, most cycles have a behavioral fractal pattern that divides into three. Divides, multiplies into three. There's lots of different reasons for that based on the harmonic nature of cycles. But just to stay on point with the framing of his work, the first stage of this triad process is expansion. That's the early stage development, basement patterns, and ultimately expansion of a period of growth, confidence, and risk-taking in terms of the actual business cycle and investment sentiment. The second stage is crisis, a collapse or correction due to excess or structural stress. There's typically a cycle skew. You can see a right skew. And number three, recovery, consolidation, repair, and eventual transition into new growth. And you can probably think aloud there in your mind to the other examples outside of markets as well, where this three-stage pattern in the human cycle and the life cycle may also align. Ultimately, these phases mirror not only economic and market trends, but also ancient ideas of the time as a cyclic and regenerative pattern. But for now, look at the one cycle divided into three. You can see the fractal pattern that it is made of, and the reasons and drivers behind stage one, expansion, two, crisis, and three, recovery. Now, what are the cycles that these are based on? And this is where it gets even more compelling. And it really starts to tease out many of the cycles that we study here at the Foundation for the Study of Cycles, and have engaged with many influencers that have published on the topic and researched it as well. So if we begin from small to big, from bottom all the way to the top, we have the business cycle that is the driving force behind the economy. That is the popular 40 or so month cycle that our co-founder Edward Dewey recognized early on and published in his book, The Mysterious Forces, which was recently republished by the Foundation. That is also known as the kitchen cycle or the business cycle, based on inventory business data. Second to that up is the Juglar cycle, developed by a French economist, which measures capital investments. That averages 7 to 11 years, averages out at about 9 to 10, often aligned with another cycle called the decennial cycle, which is different in terms of its key drivers, but maybe similar in terms of the time pattern. Think of it as a higher harmonic of the former, and then one cycle higher, the Berry cycle, a new one to many of you that are watching, based on infrastructure and within the economy, and that is an average of 33 years. Now, I want you to make one key point here: is each three cycles are related to each other, and if you multiply each one by 3, you will derive the next cycle to it. So 3 years or so times 3 gives you the jugular. 3 times jugular gives you Berry. And here's where it gets even more interesting in terms of just how macro long-term this can get. If you multiply the Berry cycle, you can then go into an order of magnitude of a 100-year cycle known as the Strauss and Howe cycle. And if you look at the interview by our chairman, Dr. Richard Smith, with Neil Howe, the co-author of Fourth Turning, which was originally co-authored by Strauss and Howe, that is the 100-year cycle. They often talk about an 80 or so year cycle. There's an inflection point at the midpoint of about 45 years, according to their work and the work of cycle practitioner Tony Plummer. But the point here is all these cycles are part of the system. They're interrelated based on the cycle harmonic. And then separate to all of that, we have the Kondratiev cycle, which many of you will be aware of, impacts interest rates, averages 54 years, and clearly is important here and now with the rise of both rates and inflation ever since 2020 and 2022. So I'll pause there with the educational framing and just let you build on the research you're already doing. And just to clarify, this is the cycle approach, most of which is within the book published by Tony Plummer. Now, let's go into each of these cycles one by one, starting with the K-wave. I'm only spotlighting a few of the cycles just so we can keep this session on point and treat it more as a spotlight of key insights, which our FSC audience can dive deeper into post-session. The K-wave, in my mind, is super important because it influences the most structural driving forces in the economy and in markets. It is so long on the other side of things that people typically don't think anything of it because it's too long to care about until it hits and things change around us. And certainly this is what happened in 2020, 2022, when we had the long cycle in rates and inflation undergo a structural change, a generational change that we have not seen in our lifetime. And certainly we can now see the early stage effects of this. And this is why anytime I hear new insights or research on the Kondratiev wave, I take note. And I encourage you all to do the same. Now, if we actually look at cycles in action, we can see that the Kondratiev is real. Seeing is believing. And you can see here this long-term chart, 200 years of US 10-year interest rates. We're all talking about interest rates at around 4.5% now after the bond market reaction to the tariff announcement just literally a few weeks ago, which led to the leadership blink moment more than once. And now we're talking about 5% threshold as a key historic level. But let's zoom out, look at the chart. You can see not only is 5% an historical average, which we've tested many times in the past and clearly could be a systemic risk moment, but also there are cycles that drive the interest rate markets and inflation. And you can see there it's approximately 60 years on an idealized cycle. It's the halfway symmetrical mix of that is 30 years up and down, but of course it can be skewed. And this is a chart that we featured a few times. FSC Chairman Richard Smith applied the cycles model onto here and derived a different spectral analysis projection. But ultimately, either way, we've demonstrated cycles in this market and how it is implying that rates and inflation will be higher for longer over the next few years. The short term, we still have to analyze day by day, week by week, month by month, especially with all the policy uncertainty. But certainly, this is an important chart to be watching. Now, our FSC Science Director, Ray Tomes, has also done tests on this cycle, and I've had active conversations with him, and the spectrum analysis that we ran at different times with different data also identifies this cyclic rhythm in commodity data, and that relates back to the drivers of this cycle in terms of the market drivers. And you can see there the blip in the chart around the 50 or so year mark. This is looking at wheat prices going back more than 1,000 years. You need a good data set up to 200 years for interest rates, or much longer for commodities, to really have enough sample data to test and measure. Now, if we circle back to the work of Valérie Gastaldy and cyclic work that she builds on, derived from Tony Plummer, we can see the latest projections showing a likely higher for longer inflation path using US CPI. Now, the important point to highlight here is that when I was speaking with Valérie about this chart, although the projection is clearly up, i.e. inflation higher for longer, she did make the due diligence point that inflation here and now is still down, diverging from the projection. So we still need to wait for confirmation. Right now, there's non-confirmation. We still need to wait for a potential resumption higher if this cycle does play out. Now, I'll play on this likely projection in a moment with some analogs that suggest that it may very well play out in due course. But for now, let the markets lead. We can only work on probabilities, not certainties, and it's good to highlight the divergence for now with the upside projection ahead. Looking at US 10-year treasuries, it's a similar story. Treasuries have actually been more volatile than directional, and higher at the moment, around 4.5%, closer to the 5% mark. And if we look at the projections with the arrow highlight, again, you can see in the next year or so, it is also looking that we will rise higher. But on this chart, it shows more volatility rather than a strong directional trend up. Now, what does all of this mean for inflation and for cross assets that perform well during inflationary times, where there typically is demand and supply shocks and all kinds of tail risk issues that can impact? Well, if we look at the inflation analog that I alluded to just a moment ago, the 1970s is a good place to start, because that's when we had a pattern of rolling waves of volatility. This was part of a late stage process, which actually kicked off with a deflationary crash. You can see part of that potential pattern, which may play out if and when markets shake out in a bigger way with a larger decline ahead, followed by a structural inflation rise back then into the 1930s, third and largest impulsive wave, which may be 6 to 12 months or more from here and now. Again, time will tell closer to the event risk itself, but certainly there are signs of inflation in the system, likely, according to many macro strategists and also cycle practitioners. The bigger part of that inflation will take place post-market shakeout into a growth slowdown and potential recession. If all of that event risk does play out, then the big wave of inflation will likely follow. Now, what do we do from an investment perspective based upon this likely rise in inflation and rates on the back of the Kondratiev cycle that we're focusing on? And the good news is that there's typically opportunity during volatility and crisis, but we have to be lateral thinkers. We have to be opportunistic. and we certainly have to be vigilant during certain times in order to capitalize on that. And this chart that we're looking at is a ratio of commodities to equities, and it goes back to the 1970s. So we're looking at generational rotation between the two assets, paper versus hard assets. And right now what it shows is that commodities is super oversold and undervalued. And if you think of the analogy of an elastic band being stretched, it is looking like it's been so stretched that at a very near-term moment, we are likely going to get a snapback in favor of commodities outperforming equities. And this will be part of a cross-asset rotation, ultimately led by the long-term structural Kondratieff wave cycle as it approaches its summer season, which is the term for that cycle in terms of higher rates and inflation. It is amplified by a great debt burden around the world. The adaptive strategy that is required for this type of environment is one that is new and tailored for such a rotation. Keep in mind, we have already had some commodities that have already outperformed, like precious metals, some early stage outperformance in industrials, although that did top out and roll over for now. And of course, we do have some cyclical moves in the agriculture sector that have yet to play out, and maybe at some point energy, if and when it recovers over the short term. But certainly commodities could be an area to position into that coming cycle. Now, let's also keep in mind that the Kondratiev cycle also suggests inflation volatility, but also socio-economic and geopolitical disruption. Here and now, 2025 and 2026 in particular, it's noteworthy that several other experts warn of potential risks, and that includes Mr. Ray Dalio of Bridgewater House, but also Strauss Howe that I just alluded to. Both of them have published on the subject. Ray Dalio, Changing World Order, Strauss Howe in Fourth Turning. In terms of the impact to society, the economy, and this shift from unipolar to multipolar world that is likely already taking effect. Watch FSC interviews with experts like David Murren of Global Forecaster and Simon Hunt of Strategic Services that also dive deeper into this. You can see the chart at the top showing the K-wave cycle based on CPI data with a flashpoint on 2025, 2026. And then also the charts down below, debt bust, economic downturn based upon the work of Dalio, and then the crisis cycle based on the work of Strauss and Howe, bottom right-hand chart. Now let's conclude on the equity market outlook based on the interview with Valérie Gastaldy. We can see here it's clearly down, but also volatile sideways pattern thereafter. Just to be clear, this is looking at rate of change. All of these charts are looking at cyclic rate of change and different momentum measures of rate of change in order to detrend some of that data. And you can see the clear directional bias down on equities for the next 6 to 12 months and certainly into 2026 and open question the year after. I'll get back to those two dates in a moment when we look at other data. Now, if we look at US equity markets here and now, this is a chart that I've been spotlighting in terms of the make or break level that the market is on at 4,800 on the S&P 500. And certainly if we hold above that as we are currently, that suggests a relief rally from oversold conditions, but it could also remain range bound in a volatile condition. If we eventually break 4,800, if and when, and sustain that, then that does suggest a larger decline thereafter. You can see a key halfway retracement of the 2020 trend at 4,200, and then an even lower target at the 2/3 retracement near 3,600 as well. These are long-term risk levels if and when the market breaks 4,800, and if not, then that line in the sand holds the market up. Let's have a look at the cycles model as developed by the foundation, and the signals here and now confirm, first and foremost, the major top that has been in place from Q1 2025. That was correctly predicted ahead of time early on in the publication of Dewey's book, the republication, based on the 41-month cycle. Look at the forward early pages and you'll see the update of that cycle suggesting a major top here and now. So that's why this top is likely important and likely in on the medium to long term basis. But if we look at the short term cycle, that also predicted a likely recovery from oversold conditions from March onwards. That matches the seasonality recovery patterns of that period. What is less clear is what happens next in the near term, whether we get a further high trajectory, whether it hits all-time highs or not. But what's interesting in terms of the next timing flashpoint, it's from summer onwards into Q3, second half of this year, where things likely get more volatile again. So look for the next few months as being a heated flashpoint in terms of market vol. Last point I want to make is, in terms of the grand scheme of things, big picture, the larger decline has yet to appear on cycle models. And this is looking at a variety of cycle models. According to the work of the guest that I interviewed, Valérie Gastaldy, and also the work that we do here at the foundation, the confluence of bearish cycles seems to appear into the end of the decade, into 2028, 2030, thereafter. There's variations depending on what data series you look at. And certainly that's what you see here at the bottom right-hand chart, based on sentiment data looking at external measures. And you can see there 2030, 31 as being a larger decline inflection point ahead. So things aren't so bad here and now. Clearly, market volatility has been strong, but there is further to come thereafter, years ahead. That's it from myself, from William, Global Cross-Asset Tactical Strategist, FSC Development Director. Welcome any feedback or questions. Please like and share this video if it's of interest, and keep engaging with our community as part of our mission for the study of cycles. Thank you very much.